part F. First, you need to calculate the price per biscuit chocolate at which RCL will neither gain nor lose from the special order. You should give reasons for all amounts excluded from the calculation. Then after that, you need to calculate the overall impact of the special order on profit. And finally, in part 3, you then need to discuss the merits and limitations of the pricing method used in F1 above. All right, so let's start with F1. We need to calculate the price per biscuit chocolate at which RCL will neither gain nor lose from the special order. So what is the price that they will neither gain nor lose from the special order? That is the minimum price, guys. So you need to calculate the minimum price, and remember, when calculating the minimum price, we only include relevant costs in our calculation. So how do we determine what a relevant cost is? Either you can apply the definition. So remember, a relevant cost is a future cash flow that arises as a direct consequence of the order. So there's 3 elements to the definition. It must happen in the future, it must be a cash flow, and it must arise as a direct consequence of the special order. As an alternative, instead of applying the definition, you can use the general rule. And I really like the general rule. With the general rule, if the cost is avoidable, it is relevant. And if it's not avoidable, it is not relevant. All right, so let's go and apply that logic to this question. Please just note also, if we have any amounts that are not relevant, so in other words, we are going to exclude them from the calculation, you need to give reasons for those amounts. Okay, so if we go back to the information provided, we know that the special order is for 15,000 units of a biscuit chocolate, and they're going to pay 18 Rand per unit, or DigiWorld, sorry, is going to pay 18 Rand per unit. But we won't take that into account in this calculation because we are not trying to calculate the profit or anything like that. We are trying to calculate the minimum cost. So what DigiWorld is actually going to be paying won't be taken into account here. We are only looking at what it's going to cost RCL to supply these 15,000 units of a biscuit chocolate. We know it's going to take 1 month for them to complete the order, and the order will be completed in full during November 2019. All right, so let's go through the applicable information over here. First, we know that 20 grams of biscuit per unit is going to be added during the blending process of milk chocolate, which will increase the unit weight of the finished product to 100 grams. Now, what you need to be careful of over here, guys, is this biscuit chocolate is an adaptation of the milk chocolate that is currently made by RCL. So don't forget any of the costs associated to producing this milk chocolate. So what am I talking about? Go back. Go back to the direct costs associated to producing milk chocolate. Okay, I'm just going to clean this up a little bit over here. So first we have direct material. Now obviously the direct material cost is going to be relevant. If we apply the definition of a relevant cost, it's a future cash flow that is going to arise as a direct consequence of this order. Obviously, if they don't have to manufacture these units or the 15,000 biscuit chocolates, then they won't incur this cost. So the direct material cost is definitely going to be relevant. So the cost is R5.25 per unit. So in order to calculate the minimum or the relevant cost, it's going to be R5.25 per unit multiplied by 15,000 units. Okay, so that deals with the direct material. Then in addition to that, we have direct labor and we also have packaging costs. Now, for the packaging, just be careful because we were told something a little bit later. We'll get to packaging. Sorry, I'm jumping a little bit around here, guys. But we were given information about packaging in one of these bullets over here. So leave out the packaging cost for now. We'll come back to the packaging. All right, so just remember, so don't forget the direct cost of R1.50 per unit. Okay, so obviously there's a chance if you leave it out now, you're going to forget it. So if I just make a note over there, then I won't forget it. But let's deal with it when we deal with all other packaging costs. All right, so that's the packaging cost there of R1.50 per unit. We'll deal with that just now. First, let's have a look at the direct labor. We weren't told that by manufacturing biscuit chocolates instead of milk chocolates, there's going to be a change in the direct labor cost. Obviously, if you are told there's going to be a change in the cost as a result of the order, you need to take that into account. If there's no change in the cost, it will still be 85 cents per chocolate. So this is also going to be relevant because it's a variable cost. It's a future cash flow that arises as a direct consequence of the special order. Or if you want to apply the general rule, it's avoidable. If they don't manufacture the biscuit chocolates, then they won't incur the cost. If they do manufacture the biscuit chocolates, then they will incur the cost. So because it's avoidable, it's relevant. And the same logic applies to the direct material. If they don't manufacture the biscuit chocolate, they won't incur the cost. If they do manufacture the biscuit chocolate, then they obviously will incur the cost. So because it's avoidable, they can avoid the cost by just not producing the biscuit chocolate, it is relevant. All right, so let's include the direct labor in our calculation over here as well. 85 cents per unit, obviously multiplied by the 15,000 units. All right, and I have a feeling quite a few of you might have left out a lot of the costs associated to the milk chocolate and only focused on the biscuit chocolate. So just be careful, that biscuit chocolate is an adaptation of the milk chocolate. So you must take these costs into account in your calculation. All right. But in addition to those direct costs, we obviously also need to take into account the relevant cost of the biscuits, which are going to be added during the blending process. So first, you're going to need to calculate how much biscuit is required in total. We know that they are going to require 20 grams of biscuit per unit. So calculate how much biscuit they need in total. Multiply that by the 15,000 units. Then, so that's obviously going to give you an answer in grams. We need to work with kilograms here, guys, because we know they currently have 50 kilograms in stock, and we've been given different prices over here per kilogram. So you can't work with the quantity in grams and then the price per kilogram. Everything obviously needs to be consistent. So if we are working with the price per kilogram, we need to know the number of kilograms that they require for this order. So remember, there are 1,000 grams in a kilogram. So if we want to convert this into kilograms, we just need to divide by 1,000. So they need 300 kilograms of biscuit for this order. Now, 50 kilograms are currently sitting in stock, and the 50 kilograms were purchased for 180 Rand per kilogram. Now, please remember, guys, that is a sunk cost. That's money that was already spent in the past. So it's not a future cash flow. Sunk costs are never relevant because they don't comply with the definition of a relevant cost. It's not a future cash flow. So that's definitely not relevant. And we were also told that the biscuit in stock has an expiration date of 31 December 2019. So that tells me if the biscuit is not used for this order, it's going to expire. So then there's no relevant cost associated to the 50 kilograms that are currently sitting in inventory. All right, they need 300 kilograms in total. 50 kilograms are sitting in inventory, which means they need to purchase another 250 kilograms. If the stock, or if the biscuits are not in inventory, the relevant cost is always the current purchase price, because obviously they need to purchase the biscuits. And the current purchase price is 195 Rand per kilogram. All right, so for the biscuit, in total, they need 300 kilograms. 50 kilograms are sitting in stock. The original cost is a sunk cost and therefore not relevant. So guys, go back to the required. You need to give reasons for all amounts excluded from the calculation. So don't just leave this out. You must give reasons. You can see there's marks awarded here for giving reasons. Then in addition to that, the biscuits are going to expire if they are not used for this order. So there is no relevant cost. Then They'll need to purchase another 250 kilograms at the current price of 195 Rand per kilogram, giving us a relevant cost there of 48,750 Rand. So that deals with the first bullet point. Then next, the increased blending time and the additional time spent on molding and packaging will cause fixed manufacturing overheads to increase by 20,000 Rand. All other fixed manufacturing overhead costs will remain unchanged. Alright, so if we are trying to calculate the minimum price and we are only looking at relevant costs, if you were told that the fixed manufacturing overhead costs will not change as a result of this order, then there's no relevant portion, because regardless of whether they accept this order or not, the fixed costs are exactly the same. However, if the fixed costs are going to increase as a direct result of this order, then the increase in the fixed costs, or the incremental portion, is relevant. However, please note, guys, the existing fixed costs of 3,823,000, that's obviously not relevant. We are only interested in the incremental portion, the additional cost that is incurred as a direct result of the special order. All right, so for the fixed overheads, just the increase of 20,000 Rand is relevant. Then, molds for 100-gram chocolates will need to be purchased at a total cost of 19,800 Rand. The molds have a useful life of 3 years, so they'll be depreciated over a period of 3 years, and they can be sold after the order is complete for 14,800 Rand. All right, so firstly, guys, they obviously need to purchase these molds as a direct result of this order. If they don't accept this order, they won't need to purchase the molds because they don't produce 100-gram chocolates. They produce 80-gram chocolates, and they already have molds for the chocolates that they produce. So the only reason why they're buying these molds is because of the special order. So this is a future cash flow that arises as a direct consequence of the order. Or alternatively, the cost is avoidable. They can avoid this cost by just not accepting the order, and because it's avoidable, it's obviously relevant. So that cost is definitely relevant, and we definitely need to take it into account in our calculation. However, the fact that the molds can be sold after the order is complete for 14,800 Rand is also relevant. So the cost that's going to affect our calculation is the net cost. They're going to spend 19,800 Rand, but after the order is complete, they'll be able to recoup 14,800. So the net effect is these molds will only cost them 5,000 Rand. So that's the relevant cost that we are going to include in our calculation. Then, the fact that the molds have a useful life of 3 years, so in other words, they'll be depreciated over a 3-year period. Remember, the depreciation will never be relevant because it's not a cash flow. So it doesn't comply with the second part of the definition. It is not a cash flow. All right, so for the molds, the relevant cost is 5,000 Rand. The net effect of what the molds are going to cost them and what they'll be able to sell them for after the order is complete. And then note, don't just leave the depreciation out, but the depreciation is not a cash flow and it is therefore not relevant. Make sure that you clearly show that. Okay. Now we get to the packaging. The packaging design needs to be modified to include DigiWorld's logo. RCL has already paid their designers 10,000 Rand for this work. So if they've already paid the designers, that is a sunk cost. It's money that's already been spent in the past. It is not a future cash flow, and therefore it is not relevant. So for the packaging design, it is a sunk cost and therefore not relevant. However, that's not the only packaging related cost that we have associated to this order. So please note, this just relates to the design of the packaging so that it can include DigiWorld's logo. obviously the actual packaging will also have a cost. And we know that for milk chocolates, the packaging costs R1.50 per unit. That is a variable cost, so it's a future cash flow that will arise as a direct consequence of this order. They obviously won't need to get or pay for the packaging for these units if the special order is not accepted. It's also avoidable. If they don't accept the order, they won't incur the cost. So because it's avoidable, it is relevant. All right, so obviously to get the cost in total, we just need to multiply by the 15,000 units. So don't get confused, guys. The one cost relates to the design, and then the other cost is the actual physical packaging. Okay. Then, to complete the order on time, the operations manager will be required to work overtime. He does not qualify for overtime pay, but RCL has agreed to pay him a once-off bonus of 8,000 Rand. All right, so that's going to be a future cash flow that arises as a direct consequence of the order. They won't pay the operations manager this once-off bonus if they don't accept the special order. So because this cost is avoidable, it is relevant. Okay. Then lastly, we are told there will be no selling or marketing costs associated to this order, and the chocolates will be collected from the factory in Wadeville by DigiWorld on the 1st of December 2019. So we said if the chocolates are going to be collected by DigiWorld, then there also won't be any transport costs. So up until this point, we've only considered all of the production-related costs. We looked at all of the direct costs associated to producing milk chocolates. We discussed the fixed manufacturing costs. Remember, only the incremental portion of 20,000 Rand is relevant. However, we have not yet discussed these period costs. Now, for the sales, marketing, and distribution costs, you were specifically told that there won't be any selling or marketing costs, and we also said there won't be any transport costs because of the fact that DigiWorld will collect the order directly from RCL's factory in Wadeville. So there won't be any distribution costs either. So this cost is definitely not relevant because the cost will not be incurred as a result of the order. But don't leave it out. We need to include that in our suggested solution. There are no selling or marketing costs, and there are also no distribution costs because the chocolates will be collected by DigiWorld. Then lastly, we have these admin costs. Now remember, the admin cost is a semi-variable cost. It includes both a fixed and a variable portion. Now we were not told, let's first discuss the fixed portion, okay? For the fixed portion, we were not told that the fixed cost is going to increase as a direct result of this order. So the fixed costs are going to remain unchanged at 900,000 Rand. Remember, we performed this calculation up front in part A of the required. Over here, the fixed costs are 900,000 Rand. So if you were told that these admin costs are going to increase as a result of the order, then obviously there would be a relevant portion, but you have not been told anything, so it's safe to assume that the fixed costs will remain at 900,000 Rand. So there's no incremental portion, there's no extra cost incurred as a direct result of the order, so there's no relevant cost. However, for the variable portion, this is a variable cost. So they are going to obviously incur additional costs as a result of the order. And the additional cost will be 80 cents per unit multiplied by 15,000 units. The cost is avoidable because if they don't accept this order, they would not incur the cost. So because it's avoidable, it's relevant. Or alternatively, if you apply the definition, it's a future cash flow that arises as a direct consequence of the order. Okay. So for the fixed admin costs, there's no change in the cost as a result of the order, so the cost is not relevant. For the variable admin costs, definitely relevant. 80 cents per unit multiplied by 15,000 units. All right, right, so we've considered all of the costs that specifically relate to this special order. We've taken into account all production-related costs as well as period costs. However, there's one thing left that we still need to consider, and that's an opportunity cost. Remember, if RCL has to sacrifice some of their existing sales as a result of this order, then we have an opportunity cost. And opportunity costs are always relevant. So if we go back, we were told on the first page that the maximum production capacity is 2 million units per annum. So they can only produce a maximum of 2 million units per annum. Now, we are dealing with the financial year 1 November 2019 to 31 October 2020. And during this same year, during the 2020 financial year, this special order is going to be fulfilled. Because if you go back to the information provided, we were told that the operations manager has committed to complete the order in full during November 2019. All right, so during the year ended 31 October 2020, they can only produce a maximum of 2 million chocolates. They are going to produce, or they budget to produce 800,000 units of milk chocolate and 300,000 units of dark chocolate. How many units of white chocolate and top deck chocolate are they going to produce? We don't have that information, but if you go back to the calculation that we performed in part A, remember where we calculated the sales mix, we know that they plan to sell 200,000 units of white chocolate and 600,000 units of top deck chocolate. But just be careful, these are the planned sales, not planned production. However, you were specifically told that no inventory of either white chocolate or top deck chocolate is held, and forecast sales equal budgeted production levels. So, if they want to sell 200,000 white chocolates, they obviously need to produce 200,000 white chocolates. And if they want to sell 600,000 top deck chocolates, they obviously need to produce 600,000 top deck chocolates. So let's have a look at this calculation. The maximum production capacity is 2 million units. They want to produce 800,000 units of milk chocolate, 300,000 units of dark chocolate, 200,000 units of white chocolate, and 600,000 units of top deck chocolate. So that means they have spare capacity for 100,000 units. This order is for 15,000 units. So they have sufficient capacity to fulfill this order plus all of the existing sales, and even after this order they will still have spare capacity for another 85,000 units. So as a result of that, there is no opportunity cost. But please remember, guys, you must always consider whether there's an opportunity cost or not. And in this case, you need to say that there is no opportunity cost, because as per the required, you need to give reasons for all amounts excluded from your calculation. All right, so they have sufficient excess capacity for the order, so there is no opportunity cost. Remember, guys, if they don't have enough capacity, so if they need to sacrifice some of their existing sales as a result of this order, how would you calculate the opportunity cost? It is always your lost contribution. So remember, contribution is sales less variable costs. That's how we calculate contribution. So your opportunity cost is always the contribution that you are losing out on because you can't produce everything that you want to produce. So let's say, for example, they are sacrificing 50,000 units of their external sales. What is the contribution that they are losing out on those 50,000 units? That is your opportunity cost. Right, so just a bit of revision over there. Then please make sure that you actually answer the required. We don't want the minimum price in total. You need to calculate the price per biscuit chocolate. So obviously we need to take the minimum price that we've calculated over here, and we need to divide that by the 15,000 chocolates to get the price per biscuit chocolate.